Hey there, fellow finance enthusiasts. Today, we're diving into a topic that's making waves in the registered investment advisor, RIA, world, the valuation gap in M&A. Now, you might be wondering, what's all the fuss about? Well, get ready to find out, because this is a game changer for advisory firm owners out there. First things first, let's talk about the two sides of this split screen. On one side, we've got the sellers, who are pretty optimistic about the future. According to DeVoe & Company's 2025 outlook, 54% of RIA leaders are expecting M&A volume to skyrocket, and 59% believe valuations will remain steady or even rise. And let me tell you, that's not just wishful thinking. We're talking about a compound annual growth rate of 17.8% since 2020, with 466 wealth management merger deals in 2025 alone. But here's the catch, on the other side of the screen, we've got the buyers. And guess what? They're not so optimistic. In a recent DeVoe survey, 82% of RIA executives expect stable valuations, while only 18% anticipate declines. Now, that's a significant shift, and it's got everyone talking. So, what's the big deal? Well, it's all about the valuation gap. You see, the gap between what sellers expect and what buyers are willing to pay is the elephant in the room. And the firms that understand why this gap exists will be the ones to escape it. It's like finding the secret sauce that sets you apart in a crowded market. Now, let's talk numbers. In 2026, RIA business valuation multiples are all over the place. We're talking 5x EBITDA for lifestyle practices with sub-$500 million in assets under management, all the way up to 13x to 15x EBITDA for billion-dollar fee-only firms with documented organic growth and second-generation advisor benches. The median valuation in 2025 hit a record-breaking 11.6x adjusted EBITDA, up from previous years. But here's the twist, the spread between a 5x deal and a 15x deal isn't random. It's all about the quality of growth behind that AUM. Can buyers model and project future revenue? Or are they buying a business built on relationships they can't see, quantify, or replicate? That's the million-dollar question. Now, let's fast forward to the Trualytics data. My brother, Jeremy Carnell, spent his career at the intersection of advisor practice management and enterprise data. And guess what? The pattern was crystal clear. Firms that had systematized their client acquisition showed dramatically better performance metrics. Lower client concentration risk, predictable revenue growth curves, and documented CAC and client lifetime value data that buyers could actually underwrite. Here's the kicker, firms with systematized, scalable, predictable organic growth commanded valuations approximately 200% higher than comparable firms that hadn't built that infrastructure. Same AUM range, same service model, same market. The differentiator? The system behind the growth. And that's what buyers pay for, certainty. Now, let's talk about the three growth models. There are essentially three ways RIA firms grow organically, and each has a very different valuation profile. First up, we've got referral-driven growth, the industry default. COI relationships, client referrals, professional networks. Important, but opaque. When your top referral source retires, the pipeline retires with them. You can't show a buyer a model, you can't forecast it, and you can't replicate it in a new market. Next, we've got lead broker growth, or rented growth. The rise of platforms like SmartAsset and Zoe has given advisors access to high-intent leads, but it comes at a cost. Lead brokers acquire that traffic for roughly $55 to $75 per lead, then sell it back to advisors at $300 to $500 per lead. And when you stop paying, the leads stop coming. You own nothing, you've learned nothing, and the signal intelligence stays with the broker. Finally, we've got systematized organic growth, or owned growth. This is the model that commands premium multiples. Not because it's more expensive to build, but because it produces something a buyer can underwrite, documented CPL that the firm owns and controls, audience data that compounds month over month, a growth system that improves with every campaign signal, and a marketing infrastructure that transfers with the firm, not back to a vendor. Now, here's the kicker. RIAs with 3-year organic growth above 10%, net of market, have tended to trade at a premium of roughly 1.0x to 1.5x to adjusted EBITDA relative to peers with organic growth below 3%. That's a significant difference, and it's all about the growth system. So, why is Q3 the window for this? Well, deal activity peaks in Q3 and Q4 as advisors look to close before year-end. That's also when buyers do their most intensive quality screening. The firms that enter the third quarter with a documented, systematized growth engine have leverage in a negotiation. The firms that enter with a referral book and a smart asset subscription are swimming in a pool where buyers are predicting a valuation flatline. Now, here's the headline for every RIA thinking about M&A. The single highest leverage investment you can make today is not in headcount, not in technology for your advisors, and not in another COI dinner. It's in documenting and systematizing your client acquisition. Buyers are predicting a valuation flatline, and they're right for most firms. But the firms with owned, data-backed, systematized growth engines are going to find that buyers still compete aggressively for them, because they're increasingly rare. In conclusion, the valuation gap is real, and it's all about the growth system. Building it is the work of the third quarter. So, if you're considering a transaction in the next 2 to 5 years, start building that infrastructure now. The right platform can compress what historically took years of expensive agency relationships into something operational in weeks. And that's the definition of a compounding growth asset. That's what buyers pay up for. Thanks for watching, and remember, the future is all about the growth system.